All right, Mike, thank you very much. Back to our top story tonight. The head of America's central bank defended the massive stimulus policies that he's enacted since the 2008 financial crisis. Federal Reserve Chairman Ben Bernanke faced off in a hearing with U.S. lawmakers over the Fed's ability to tackle more than $3 trillion on the balance sheet. Daniel Ryntjes has been following this, and he attended the hearing and joins us live from Capitol Hill. Daniel?
Yes, Republicans have actually seized on concerns expressed within the Federal Reserve Open Market Committee itself. And now Fed Chairman Ben Bernanke is being forced to reassure the markets and the general public that they're onto it. In his semi-annual report to Congress, Ben Bernanke is facing the heat from Republican lawmakers who think the Fed's easy money policies are creating unforeseen risks. Now they're citing the recently released minutes of the January meeting of the U.S. Federal Open Markets Committee, or FOMC, which sets lending rates for the banking industry.
Several FOMC members expressed concern that the Fed's prolonged easy money policies could result in excessive risk-taking and threaten the financial stability of the United States. These concerns warrant serious consideration, given the scale, scope, and duration of the Fed's unconventional monetary policies.
Republicans are worried about how the Fed will sell off some of its more than $3 trillion of assets, even as it continues buying $85 billion a month in U.S. Treasuries and mortgage-backed securities, a policy that's increased the U.S. money supply. Bernanke says he's confident in the ability of the Fed to make the right moves at the right time. But he acknowledges that there are risks from public fear of inflation becoming a self-fulfilling prophecy.
For example, if further expansion of the Federal Reserve's balance sheet were to undermine public confidence in our ability to exit smoothly from our accommodative policies at the appropriate time, inflation expectations could rise, putting the FOMC's price stability objective at risk. However, the committee remains confident that it has the tools necessary to tighten monetary policy when the time comes to do so.
So it's no coincidence that the most aggressive stimulus effort in U.S. history is combined with efforts to make the Fed's policies the most publicly transparent and predictable of all time. And of course, Fed Chairman Ben Bernanke once again touted the benefits of his easy money policy on the economic recovery here in the United States, and also on countries which are reliant on exports into the U.S. market. Back to you.
Daniel, there's so much criticism about what's happening here, concerns about inflation, also concerns that potentially there may be new bubbles propping up as well. How did he deal with some of those concerns?
Well, he's saying that risk is part of the economy, that there are risks in stimulating the economy to this extent, that they are monitoring those risks. So one example, for example, is that agricultural prices have shot up in the last few months. But he's also saying that the risks of not doing this action were also immense, and that given the fact that inflation is still manageable, controllable, those risks are worth it in today's economy. But of course, he is nodding now to those who are criticizing the Federal Reserve about this easy money policy and saying that more is being done within the Fed to identify any future risks that may come forward.
Daniel, you're there on Capitol Hill. There's another big debate that's happening regarding spending cuts. Republicans and Democrats no closer to a deal to prevent those automatic cuts known as sequestration. Did Bernanke mention this issue at all?
Yes, he did, in the context of the Congressional Budget Office. They're like the referees. When policymakers come up with ideas, they come up with the figures. The figures are this, that the current sequestration could dent economic growth this year by 0.6%, and that potentially the whole policy could waste about 750,000 jobs. So this could potentially have a major impact, and Fed Chairman Ben Bernanke wants them to know it.
All right. There is a lot at stake, Daniel. Thank you very much. Daniel Ryntjes joining us live from Capitol Hill. We now move on to David Jones, who's going to help us with more analysis, President and CEO of DMJ Advisors, joining us live from Fort Myers in Florida. David, thank you and welcome to Biz Asia America. You know, there's so much to talk about. I'm going to try to keep this as simple as possible. Let's start with the QE3, 2, and QE1. There was controversy going into all three of these programs, including Operation Twist. Were those criticisms justified now that we're several years out into the program?
Well, I don't want to criticize those earlier QE1, probably QE2. Remember, QE1 was huge, 1.725 trillion, and it was aimed at really getting the recovery going. I have to give the Fed credit. They were unconventionally involved in large-scale bond purchases to try to push down longer-term interest rates in order particularly to get the housing sector going, and I have to give them some credit. It's finally picking up. The second QE, 600 billion, was mainly aimed at fighting what the Fed at least viewed as the potential for deflation. So the Fed was very worried about that. There is an issue about this open-ended QE3, which is going on right now, 85 billion in bond purchases per month. That'll add $1 trillion to an already high Fed balance, which is at $3 trillion. Normal Fed balance sheet is like 850 billion. So I think the Fed may be getting may have gone a bit too far with this open-ended QE3.
David, with that said, Bloomberg is reporting earlier today that if interest rates rise, that the Fed potentially, because of the size of the balance sheet, could lose up to $500 billion. Is this real, or do you think this is just more hype from the media?
Well, it's a bit of hype because we have to remember that it's just a matter of how much in profits the Fed is giving back to the Treasury. Having bought all of these bonds, the Fed is making rather large amounts of interest earnings on those bonds, and 90% of that goes back to the federal government. So it becomes at least a factor in the budget. But when all is said and done, if the Fed ends up, because of higher interest rates, paying more of that to banks in terms of interest on excess reserves, it's still not going to make a big difference in terms of how much the government has to cut these huge deficits and these huge budget expenditures looking ahead.
One of the biggest questions that everyone is asking is what you mentioned earlier, which was how does the Fed now exit the QE programs? And perhaps some perspective here might help. The reason why the Fed brought rates to zero to not just stimulate the economy was also because they wanted to raise asset prices, in particular the housing market at that time. With raising the prices, that also raises the probability of potentially inflation, which we aren't seeing quite yet. But does that have an effect as to when QE3 or all these QEs potentially could end?
Well, we have to remember there are two key decisions. Chairman Bernanke talked about this today. The first decision is whether or not to cut back on this 85 billion per month in bond purchases. That decision, it looks like, is going to be based not as much on the employment picture, although the Fed chairman talked about that today, but on this cost-benefit analysis, which the Fed is doing. And part of the cost is what you allude to, which is the possibility that it's going to be very difficult with a balance sheet that's $3 trillion to unwind that balance sheet without causing a huge increase in market interest rates and a big decline in the stock market. As you alluded to, we've seen long-term interest rates artificially low and stock prices artificially high because of all of this quantitative easing by the Fed.
That's right.
So my view is
that's right. Housing prices have bounced back. The stock market's bounced back. If you were advising the Fed Chairman Ben Bernanke right here, right now, how would you advise him on how to exit this particular strategy without causing concern in the marketplace?
I tell him to begin sometime in the second half of this year to pull back in the size of those unconventional large-scale bond purchases. Pull back from 85 billion per month, maybe sometime around September of this year, to maybe 60 billion per month, and then pull back in a couple of months to 50 billion per month. Just taper back those bond purchases based on the idea that the higher the Fed's balance sheet, the more difficult that exit strategy will be. Then the next decision is the one when the Fed starts raising its target federal funds rate. That will depend, as the Fed has already said, on bringing the unemployment rate down to 6.5% from the current level of 7.9. So that may be further in the future.
David Jones, President and CEO of DMJ Advisors, joining us from Fort Myers, Florida. Thank you so much for being on the show and helping us better understand what's really at stake here.